So are fixed index annuities too good to be true? Well, ladies and gents, just here to drop a few cents. You're with Earl, the money coach. And today I want to break down if they're too good to be true. Now, on one hand, fixed index annuities, you get that promise, all right, of safety. You get the growth. You don't have to worry about the market loss. But on the other hand, you have a lot of critics that say it's too complex. They're full of fees, cost, and it's not worth it. But here's the truth. In actuality, it's somewhat in between. It's somewhat in the middle. And in this video, I want to explain to you exactly how fixed index annuities work, the pros, the cons, and ultimately who is probably going to be good for. Because this strategy, I don't care what nobody says, it's not for everybody. So make sure you stick with me to the end. Make sure you guys like, follow, subscribe, and leave a comment below if you want to know more about fixed index annuities. Well, let me get right to it. Ultimately speaking, if you want to move money from a 401k or an IRA into a fixed index annuity, you need to know what is it. So here it is. What is a fixed index annuity? Ultimately speaking, fixed index annuities, or FIAs, as some people talk and refer them to, is a contract that's offered through a insurance company, folks. A insurance company. So here's how it works. You put your money in your fixed index annuity, right? Your money is protected. You can't lose any principal due to market downturns, okay? And instead of earning a fixed rate like your CDs or anything like that, your interest is tied to a stock market, the S&P 500, the NASDAQ, whatever that company provides. If your index goes up, your money gets to gain interest. If the market goes down, you don't lose money. We call that MCP, market protection. But not just market protection, market correction protection. Now, it sounds great, but let me break down exactly how it works and how you get credited, okay? When you have a fixed index annuity, and this here is sometimes misled because a lot of people don't understand, is the insurance company, they use formulas. That's all it is. They use formulas to pretty much determine how much index growth you actually get. That could be from your cap rate, all right? You have a maximum amount. You have a cap, meaning if the market does 20%, but your cap is 11%, you're only going to get 11%. That's your cap rate. Then you have a participation rate, all right? That's the percentage of growth that you get to keep. So let's say if it's a 70% participation rate, okay, the market has a 10% gain, you get 70% of that. So that would be considered 7%. So a 10% gain, right, but a 70% participation rate means you're going to get credited 7%. Then you have the spread, and that's pretty much the percentage subtracted from the growth before applying that to your account. So yes, you're protected from the losses, but you're also going to give up what we call the upside potential. This is not an investment, folks. This is a supercharged saving strategy that reflects the market. So that gives you pros. Let's talk about the pros. Let's talk about the cons. The biggest pro is you have principal protection. No matter what happens, you will never lose your initial investment. You have $100,000, the market crashes 30%, you're still at $100,000. Now, you also have growth potential. It's better than your traditional fixed annuity or your CDs or some of these strategies, especially in those good years. And also, you have tax deferred growth. You don't pay taxes until you withdraw, depending on how your principal was put into the account. And then you have a lifetime income option. You could turn on a lifetime income rider even after your principal and the funds roll through and you spend them with that lifetime income, it's still growing for you. So that's huge. It gives you a peace of mind. You don't have to worry about anything. But also, you're going to have cons. Because I tell people, nothing's perfect. No financial strategy is perfect. So the cons for your fixed index annuity is this. Number one, you're going to have limited growth. You'll never get the full market return, only a portion. Understand that. Now, number two, they're complex. You got different crediting methods, surrender charges, participation rates. If you want a bonus, all these kind of things, they're charges. Then you have liquidity restrictions. Meaning these are contracts. If you have a 10-year annuity, you need to leave it in there for 10 years. If you touch it earlier, you could have certain fees, which bring up some of these kind of fees, like I say, your surrender charges. So you have to put all these things into effect that you're locking yourself into a contract. You get the growth, but guess what? You may have some cons that you need to factor in. But let's talk about the biggest mistake. For what I've seen, I've been licensed for the last decade, folks. One of the biggest mistakes that I see is that too many people, they buy whatever their bank or agent recommends. You cannot do that. Do your own research. I'm a broker. I work with multiple companies, but they might not be the best company for your specific needs. So do your own research. Some annuities are great for some of you, but for others, it may be horrible. So you want to make sure you find the right one that's best for the best growth that you need, or else you could end up disappointed because not every annuity is created equal, especially when it comes to your fixed index annuities. So here's the main question: are annuities good or are annuities bad? Well, I always tell people it really depends. If you want that safety, if you want that guaranteed growth, if you want it to be modest, you're not trying to, outpace anything too crazy, a great strategy. Now, if you want maximum growth, if you're trying to have liquid, if you're trying to double your money quick, this isn't for you. The key is understanding the details of the fixed index annuity and how it could work. I always say ultimately your annuities are supplemental income. Now, what does that mean? When you retire, you're making $8,000 a month. Your annuity needs to be a supplemental income. You get $1,800 from your annuity, $1,500 from your Social Security, $1,200 from a 401k, another $2,000 from your IRA. All these are going to supplement your main income. So when you look at annuities, look at it as a portion of your income that you are supplementing that gives you lifetime income that you never have to worry about losing. So folks, if you want to dive deeper, make sure you guys like, follow, and subscribe. And in my description, there's a link where we can schedule a consultation. I could run some quotes for you to see what's on my platform, if it's the best thing for you or not. And with that being said, I'll see you on the next one.